I don't think any central bank is 100% independent. There's always some degree of relationship with the government. But to me, what I'm really focused on is the degree of independence. And if the market perceives there being less independence going forward, that's problematic. I mean, as you heard the president say, every 1 percentage point of interest rates is $360 billion of interest on the debt. But to me, that highlights the exact point here. The US has $36 trillion of debt outstanding. And if we expect global investors to continue buying those treasury bonds, that requires those investors to believe that the Fed is going to be very diligent in controlling inflation, managing its dual mandate. And what investors do not want to see is a central bank that responds to the president's pronouncements, regardless of who that president is, by the way. And if you look across economies globally over many years, there is a very clear relationship between central bank independence and low interest rates and inflation. And when you lose that independence, it can be extremely expensive.
Let's talk about the rally in the U.S. dollar just overnight. It seems like now the U.S. dollar is turning higher because of positive trade headlines. Do you think this is something that is happening because of some tactical moves coming through, or is this a turnaround for the direction of the dollar?
Yeah, I think what we might be seeing is a couple of things. One is consensus has turned quite negative on the dollar over the last few months. I mean, it really started in late March, early April, around the announcement of reciprocal tariffs. The dollar, as you know, has weakened materially year to date. And I think what we might be seeing is a bit of relief that as we get trade deal after trade deal, the uncertainty is going down. We're getting a bit more visibility on what the outlook will look like. And so we've had a move up today that was quite strong on a single day basis. But the year-to-date trend is clearly to the negative. And I can tell you, I think over the next few years, the trend will likely remain negative. Now, could you have up moves in the dollar? Could we strengthen 3 to 5%? That's entirely possible. But I think what I'm hearing from global investors, global asset owners, is a concern that their exposure to U.S. assets in total is very high. If you look at the U.S. equity market as a percentage of the MSCI All Country World Index, it's 65%. Foreign investors own $9.5 trillion U.S. treasuries. And I think a lot of investors outside of the U.S. are saying maybe it's time to dial that down just a little bit on the margin because of fears around Fed independence, policy variability in the United States, polarization, rule of law. There are a lot of factors coming into play where people are questioning just how much money they want dedicated to U.S. assets.
And how much of this is also coming from the fact that, I mean, looking at very sharp rebound, the bounce back in U.S. equities from early April, people are thinking, man, if an investor was selling, sort of rage selling because of the tariff fear, then maybe I should have held on. Maybe the U.S. exceptionalism is not going to disappear so quickly.
No, I think you make a great point. And I've been asked many times, is American exceptionalism over? And I don't think this is an on-off switch. It's a dial again. And, we've had years of U.S. economic outperformance and equity market outperformance. And by the way, a good chunk of that outperformance was driven by earnings growth outperformance, but a significant portion was also driven by valuations. And I think what you're seeing now is people are looking at the United States where trade policy and immigration policy and fiscal deficits are all pointing in a bit more negative direction for economic growth and earnings growth. And at the same time, outside of the U.S., there are signs, encouraging signs, that maybe Europe is turning the corner. Maybe Japan is improving returns on capital. Maybe China's ready to engage some structural issues. And those markets are all materially less expensive than the United States. So I do think, one of the things a lot of investors are grappling with is, for the last 15 years, you learned that you should buy every dip in the United States. But at this point, with the S&P at 22.5 times earnings, this is priced nearly for perfection.
Yeah, it's also, such a deeply embedded kind of a mentality here that maybe it's really hard to shake off. But at the same time, the U.S. earnings season. So we've got a massive week in terms of U.S. earnings this week, Ron. Anything that you're looking out for? Because earnings expectations has been coming down. Maybe that is actually a good setup for further upside.
Yeah, it's interesting, by the way, if you look at the earnings reports so far, and about a third of the S&P 500 by market capitalization has reported through today. If you exclude tech earnings, the earnings growth is less than 1% for the rest of the market. And by the way, if you look at the entire market, what's really been driving all of the earnings is tech and financials. The rest of the market has down earnings. And so I think what people should be watching for is to see what are the effects of policy on earnings. It's too early to see the tariff effect on inflation and macro indicators, but it's also too early to see it for most companies. It's going to take time to flow through. And what I think is really interesting on the trade policy front, the biggest losers from the US tariffs and trade policy are actually the old economy stocks, think industrials, consumer stocks. The companies that are least affected in many cases are financial services because they don't import anything. Or in many cases, think of the big tech companies, some of the software companies also not subject to tariffs, but more vulnerable to retaliation, which seems to be receding as a threat. So I'm watching for broadening out. I'm watching to see how this progresses over the next few quarters. And I do think there is a risk that pain trade could be higher near term in the US market. But I also think there's quite a bit of upside in non-US markets as well. So again, this is a case where people should be stepping back and thinking about their long-term asset allocation and where they want that next dollar of capital.
So if you're thinking long-term and want to broaden out, just sort of go beyond the U.S. that we spent some time talking about, what is your favorite idea for the second half of this year to allocate new money in?
Well, I would say it's the second half of this year, and actually it's more about putting money in for the next 5 to 10 years. I think emerging markets are ready to shine. I think this is as part of the market, by the way, where if you look in the United States in particular, and I also see it in Europe as well, people have decided not to even bother after years of underperformance. They look and say, you just need a large allocation to the United States. People are more optimistic about Europe now. But I think EM is an asset class that people are underinvested in, and basically that their expectations have come down so much that it's a low bar for outperformance. So I do think you're going to see better earnings growth in emerging markets than you're going to see in the United States. You're going to see better economic growth. And in many cases, when you look at the sovereign balance sheets in emerging markets, they're in a better fiscal position than a lot of developed markets. And last but not least, you've got a market that is trading at a 9 PE multiple discount to the United States. So I would say emerging markets number one, followed by Japan, then Europe. And by the way, Japan, not a 10-year trade. I think it's more of a 3 to 5 year capital optimization, corporate governance improvement story that could materially raise returns on capital. And then Europe's probably a longer term story that's in the earlier stages, but I would say EM first and foremost.
You know, I'm not defending U.S. exceptionalism, but just to push back and have a fun conversation with you, Ron. Some folks are saying, I mean, look at, the top 50 companies in the world, global companies in whatever sector, they're all in the United States. And perhaps you're looking at a demographic dividend story out of India or even China still. And hey, look at what robots can do in the next 5 years. So perhaps the story for the U.S. is still staying intact, and sure, the nominal level of GDP growth for these emerging markets could be there, but the U.S. is showing good quality.
I agree with everything you said. By the way, I'm glad you asked the follow-up. I'm not saying sell all of your U.S. equities, not even close. My discussion with most investors is on the margin, if you have basically 60% of your equity exposure in the United States, over the next 3, 5, 10 years, how much do you want to dial that down? Because US exceptionalism cannot persist forever. They're great companies in the United States, and you're absolutely right when you mention quality. The US has a greater representation of quality companies by market capitalization than any other country. So there's some great companies here that can give you exposure to global growth. You just have to be careful about understanding how much you should pay for those companies, what valuation level is appropriate, and also recognize, by the way, there are great companies in Europe, there are great companies in Japan, and there are great companies in emerging markets across the regions. And I think after many years of basically being full throttle bullish on the US, it's time to consider other options for that marginal unit of capital in terms of moving that to a different region while still maintaining a sizable position in US equities.